In this video, we will be reviewing what happened with Terra and Luna. At this point in time, I'm sure many of you are well familiar with the TerraLuna crash, and in general are probably curious to understand the role of stablecoins. Now, stablecoins are the primary on-ramp for individuals trading, or rather for individuals wanting to invest in crypto. So really, there are, I think, an order of magnitude more trading pairs supported in stablecoins than there are in fiat assets in the crypto industry. And this is for a number of reasons. Primarily, it's due to capital controls, and of course, it also has to do with maintaining sort of the non-sovereignty of Bitcoin centralized exchanges for some of the more larger players like Binance and such. Now, specifically when it comes to UST, UST is a programmatic stablecoin, and essentially what that means is that unlike stablecoins that might be maintaining a peg that is one-to-one peg or a fractional reserve peg, the peg here is maintained algorithmically. So really, all that means is that in the case of Terra and Luna, you had two assets. You had Luna, which is a counterpart to Terra, which would create an arbitrage supply through modulation in its issuance, such that it would create arbitrage opportunity with Terra, thereby incentivizing traders to generate a premium from that arbitrage to reestablish the peg. At a very high level, this is how it was supposed to work. But there were a number of things that went wrong here. And this article right here goes over some of those issues at a higher level. Particularly the part you could focus on is the beginning part of this article here, where it mentions that $350 million of UST was swapped for UST or USDT using the curve pool. And this essentially created a financial contagion across the UST market, which then, of course, had rippling effects across other stable markets and then the wider crypto market. This is a fairly short article, so for those of you that are looking for a higher level crash course into what happened, this covers that. For those that are interested in a much more deeper dive, I would suggest this article written by Jump. It goes over almost like week after or day after day what was going on and how this ended up affecting the UST ecosystem. And then furthermore, this article specifically, it is a data-driven approach to the same UST collapse, but what we've really appreciated about this internal to Pareto is how this actually gives a decent idea as to how the different stablecoins differ. There has, of course, been a lot of discussion around the stability of all stablecoins, but I think prior to having that discussion, it's important to understand how they function differently and what the implications of those are, particularly with respect to their fragility and what type of fragility they introduce to the crypto space overall. So this article, for example, will show you how the order books differ for different types of stablecoins. Here you have, it says here UST and DAI, and DAI is again another stablecoin. Those order books look like this, where you basically only have liquidity really just at the center because it doesn't really need to be maintained external to that, as there's not really an expectation of strong deviations from it, which, by the way, also presents additional issues, which we'll cover in a future video. Normally markets look like this, where you have, of course, a V-shaped central limit order book or CLOB, and that's for price discovery purposes, of course. And of course, you can always have skewedness in liquidity for a number of reasons. But what's interesting about the USDT market, particularly right prior to the collapse, was that a massive asymmetry manifested across the order book. And that's what this article covers. So definitely recommend reviewing this as well. And as always, if you have questions, please let me know.